This is Shelley Craft coming to you live on SNNLive. We're coming to you from the Sprott Natural Resource Symposium 2017 here in Vancouver. I have with me Daniel Major, GoviEx Uranium Inc. It's a publicly traded company. I'm going to give you two symbols, GXU on the TSX-V and GVXXF on the OTC in the US. Daniel, welcome back to SNNLive.
Thanks, Shelley. Always appreciate the time.
So let's start out with a short overview of the company, and then we'll go from there.
No, absolutely. GoviEx has got 3 projects in Africa, all in uranium. We have one of the largest resources of any of the uranium companies at over 208 million pounds. But more importantly, 2 of our projects are already mine permitted. We're working on the financing structure already on our main project in Niger. We're completing a transaction in Zambia, expanding that resource, and that one will be looking at a PEA coming out. So advanced uranium projects in Africa, low cost.
With the growth of the obvious nuclear industry, how does that affect your projects?
Our focus is all about development, and that's going to be the key to us when you look at us against other uranium companies. We're going to be one of the few guys that's actually going to build a mine in this cycle and turn it into cash flow. So what we're seeing is 2 sides to this market. One is the demand side, which you just mentioned, but the other thing, we've just done a lot of work on analyzing the supply side, and it is clear that the supply side needs well over $60 to be able to balance new production to come in and start to fill that supply gap that's going to be appearing in the next 2 to 3 years.
So $20 a pound, right, currently approximately, versus needing a higher price. How do you work that out?
The issue at the moment is that there is oversupply coming into the market. You've got excess secondary material coming through. You've also got most people with long-term contracts in place. So the situation you're going to see is those long-term contracts unwind, they're going to have to recontract. And as a result, that's going to help pull the price up because nobody at the moment can replace their resources based on the current price. And that's important even to the current producers. On the other side, you are going to see declining supply to the market anyway, and that is going to start putting the pressure on. So I think at the moment, the bet for the buyers has been to do nothing, and they've been right to do nothing. You are going to see a scenario very soon where you are going to see momentum. We're starting to see it already pick into the price, but I think you're going to see a bunch of little fishies swimming after each other pretty soon.
From the outside looking in,
yeah.
If I paint the scenario that I'm a supplier, my cost is, I'm losing money selling at $20 a pound. Mm-hmm. Why should I continue to sell it? Why shouldn't I just sit on my project and not ship anything at a loss and just wait for the price to go up? And that would, in effect, help the price go up.
Well, I think the first point you have to note is that that $20 price is actually the spot price. It's not the term price or the contract price that's out there. The term price is actually $30. But more importantly, a lot of these guys are sitting on much higher price contracts. So they're well over $50, $60 prices. So that's what they're currently selling at. The issue that they've got is those contracts are unwinding. And you're absolutely right. The problem they're going to have is that when those contracts unwind, in the next 3 years, you're going to see at least 30% of contracts unwind. 5 years from now, 75% of all contracts will have unwound. And that is the point that those producers have got to make that decision. Either get a new contract back at a price they can afford, or they have to shut down. And then you're correct. If they shut down, that just reduces the supply even more, in which case the price goes up anyway, and that becomes the Damocles sword that's going to be sitting on the industry sometime in the future, which is the threat that if you don't give them the right price, they cut production anyway, in which case the price goes up, in which case you might as well give them the contract in the first place. How
does that affect you?
Well, I mean, our whole focus here has been on the 2020 figure. We see prices moving well before that. Once we see that momentum, the large off-takers are indicating they will negotiate at around the 50-plus level that we need to get our projects away. Our target's to be in production for 2020, which is where we see that supply gap open up. And we can do that because we're permitted, because we're already having those discussions about how we're going to finance, advancing the debt discussions, advancing those debt due diligence work, talking to the off-takers. It suits us absolutely perfect, but more importantly, that's how we're designing the company to target that area. If it drags on a bit, then obviously we just move a little bit slower on the way that we're operating.
So compared to your resource, What else is out there that's comparable? And why wouldn't a large user contract with you even sooner if they could?
Back to the comment I made earlier about it's not being wrong to do nothing. We're talking to the large off-takers, and they just want to see that momentum in price. They do want to contract with us. One of the benefits we have is our project's bigger than £2.5 million per annum. That makes us a world-class scale project, and that, for the big users, is what they want. They want long, large-scale projects. They don't want small, short-scale projects. So for them, they just want to see that price momentum, then they're willing to negotiate.
And there's no downside to being in Africa politically, nationally?
No, I mean, I would point out to people, if you were in Western Australia, you can't get a mining permit at all. So risk is a multifaceted thing in our industry. We have 2 permitted projects in stable jurisdictions. Niger's been producing uranium for 45 years. Zambia's been a long-term copper producer who wants to diversify its commodity spread. No, we see no. And the other point I think I'd like to make is that in the last cycle, 3 of the largest takeout transactions were in Africa, all over $1 billion.
Who's the big offtake user for the African uranium?
It actually goes to a number of places. The single largest one is France, because Areva is obviously producing there, so they take a third of France's nuclear requirement comes from there. But it also goes into the US and Canada as well. So the one thing about uranium, it is a global commodity once it goes into the market.
Daniel, let's get your website out there for our investor audience, if you would.
Absolutely. GoviEx.com. That's GOVIEX.com.
Ladies and gentlemen, Daniel Major, GoviEx Uranium Inc. It's a publicly traded company. I'm going to give you 2 symbols. GXU on the TSX-V and GVXXF on the OTC in the U.S. I'm Shelley Kraft. This is SNNLive, and we're coming to you from the Sprott Natural Resource Symposium 2017 in Vancouver. Daniel, thanks for coming on.
Always a pleasure.